some market veterans say we've seen reversals like yesterday's, but rarely compressed into such a short part of the session.
Yes.
Had you seen anything like that before?
So I've been in the business 30 years, and I've seen a lot of these. I've seen 87, but this was quite dramatic.
Why did it happen, do you think?
So I think it's a lot of volume trying to go through in very thin market conditions. I would not read so much into the amplitude of the moves, but the direction is still important. And I think that's what you should take your cue from.
Does it mean something else in the days to come, weeks to come?
So we personally think that, barring three things going seriously out of hand, the three things you listed. One is the wheels don't fall off on the policy front in DC or internationally. If the Fed shows some consideration for the amount of market mayhem and for the tightening of financial conditions. And third, we should see some signs of growth, some result from the easing in Chinese policy. I mean, this is now 6 months, and we should see some results. We expect all of those to happen, and we expect the next 6-9 months should be very positive for markets. We've seen a dramatic derating of equities, far in excess of what you see on the tape. So the derating of equities, or the rise in the equity risk premium, is about twice as much as the amount the market's down this year.
What did you say, if the wheels don't fall off in Washington? How do we measure that? We're in our 7th day of a government shutdown.
Well, it's a partial shutdown.
Losing cabinet members.
We've seen shutdowns before. But markets, what I'm trying to say is that markets don't like uncertainty. I mean, they have very low tolerance for uncertainty, and at some point, the real economy as well.
Jim, we've been talking a lot last few days about this pension rebalancing out of bonds into stocks and kind of treating it as a mechanical factor here, a source of demand for stocks. But it also, of course, reflects that these two markets have kind of gotten out of whack. So if you had any portfolio right now, is the logic pointing you to rebuilding equity positions, or would you wait and see at this point?
I think the logic is telling you to wait and see for at least a handful of weeks. When we get fourth quarter earnings, that will likely be the catalyst for the next leg up in this market, but we want to see the facts before we make any dramatic new moves. But I think your point of remaining well balanced from an investment standpoint in both stocks and bonds continues to make sense. Fear is an adrenaline state. It dissipates in the face of facts, and so far the facts, whether we're looking at economic data, earnings data, or interest rates, continue to suggest that slow growth, not no growth, is a road that's going to be profitable for investors down the long term. In terms of what's facing us just at year end and the start of 2019, obviously fear, volatility, and volume and velocity are going to wreak havoc, I think, with investors' nerves on the short term. But long term, this is precisely the kind of market that gives us some wealth building opportunities over any investment timeline.
Jim, if you are going to be patient, where do you wait? Because there's discussion today about why the bid to cover on the 2-year was relatively weak. I mean, is there an overhang of supply in treasuries? Do you go to cash instead? I mean, where are the sidelines in your view?
Well, with cash reserves, money market funds yielding about 2%, that wouldn't be a bad place to keep some dry powder. We definitely think that actively managed bond funds with managers who've been able to provide a track record through times like these makes good sense. But again, this is a great time to add to some of your best long-term managers who are capable of stepping in on days when the market swoons and add to their best ideas at steeply discounted, fear-driven prices.
I mean, here's my problem, Vinay, with so many people, and Jim's not alone, coming on and saying there's a disconnect between the economy and the markets. And if you don't think the economy is going into recession, you buy the market because it's overblown here. On the way up, I mean, QE 1, 2, 3, nobody was saying there's a disconnect. The economy doesn't look this strong. It was buy stocks because the Fed was pumping liquidity and free money into the system, no matter what. That's unwinding. So it's not going to be necessarily reflective of the fundamentals if we see asset prices move the other way, is it?
So most likely rates are going to prove a headwind to equity market performance, as they did this year, right? I mean, that's what we face. But why do we expect rates to rise? It's because we do not expect the economy to fall into recession. You asked my colleague about, why was the bid to cover so low?
No, but also it's because the Fed wants to get back to a normalization of its balance sheet.
Sure.
Which it made very clear in the last news conference, no matter what the economy is doing.
So I have not met 2 economists who agree on the impact of QE. All right? I mean, you sit in forums where they say...
But everybody agrees that it propped up the stock market.
No.
No?
I mean,
You don't
in the
think
sense
QE
that
propped up the market?
in the sense that it conveyed that the Fed was very serious, right? It was a signaling tool. It was a signaling tool that we're going to keep rates low till the economy recovers.
It's so funny you say that.
And you
'cause
put your money where your
we were
mouth is.
having this exact discussion yesterday.
And it becomes very difficult to, I think, even if you're the Fed, to say, you know, most of the benefit was in your head after the market kind of averted ultimate
They
disaster.
specifically talked about the wealth effect.
Oh, there was Bernanke talked about the wealth effect.
Yeah.
Absolutely. No, there was, but I think you have to sort of say at what point during QE did that stop really mattering as much? And that's, that's the debate.
So in Japan, they bought so much equities. You know, that's what QE did.
Yeah.
Did that boost the stock market? You bet. Did anyone buy equities here? Not really. Most of the buying was in risk-free instruments. Some of it was very powerful. It was in mortgages. And yes, that definitely had an impact on risk assets.
Jim, I wonder how you think about the either emotional or quantitative aspect of QT. And how much of that do you think is at risk given reports about whether or not Powell should meet with the president at the White House or whether that's a treacherous meeting to have or not?
Well, I don't think it's a treacherous meeting. I think the two could be well met. God knows what the tweets will be after that meeting. But I don't think it hurts the Fed to have that kind of conversation. The Fed, I think, is likely increasingly independent precisely because of Washington politics trying to sort of run their business for them. I think there's no argument in my book that the Fed definitely safeguarded the economy, which was on the brink back in 2009, and provided a floor for equity investors to be able to get up and run. But ultimately, we don't buy markets. We invest in active managers who are very selective in terms of what they own. So their portfolio might have 30, 40, 60 names in it, not 500, 1,000, 2,500 names. This is a market, 2019, 2018 as well, was one where stock selection, active management, as opposed to index investing, clearly came to the fore.